Joining us now is Bob Iaccino, Chief Market Strategist at Path Trading Partners. Bob, it's good to have you with us. Look, an hour ago we were looking at these shares up about 2-3%, and since then they've turned lower. What's behind the stock move down?
Yeah, good morning. I think it has quite a bit to do with that revenue miss. This entire earnings season is really about the revenue miss. When I look at Spotify, and it's not an area that I invest in necessarily, because I think there's stage 2 and stage 3 of that particular industry that kind of has to get sorted out. There's a lot of competition, but those numbers were phenomenal. If you believe in the long-term growth of the streaming music services, Spotify's definitely got to be a leader. I mean, we've got Apple coming up. That could be part of the sell-off. People want to see how well Apple did in terms of taking market share from Spotify. But regardless of that, the growth, I mean, from 173 million to 217 million, from 100 subscribers to almost 100 million subscribers now on their bottom line, that seems pretty phenomenal to me, even though I don't own the stock.
Yeah, Bob, one area of the company that didn't grow was average revenue per user. That down 2%. This coming at a time when subscribers are increasingly subscribing to the service via bundles. Some of the subscriber growth came from outside of the U.S., where where subscriptions are less expensive. How do you read into that figure?
Well, I think you have to, again, buy into Spotify's podcast model that they want to use going forward, which I kind of do. I mean, the user time is going to go down if it's a podcast-focused situation, because you're just going to get the amount of time the podcast that people listen to. It's a smaller number now, but it's growing rapidly. You're going to get, that's going to be your listening window, and that's about it. So you could see average user time go down based on that. But again, when you look at the actual numbers, the actual revenue, they're a cash machine. If you like the space, which I'm not a genuine fan of, I think this is one of the stocks you have to buy, and this is an opportunity to get into it and hang on to it medium term. There's something to me about this space that I kind of associate with your Netflix and your Amazon, which I think everybody does, but I wonder when the streaming services start getting involved in their own content. In other words, backing actual podcasts, backing actual bands, creating their own sort of streaming record labels. I think that's probably the next step. That's when I'd start to look at this stock personally. It could be Apple that leads in it. I'm not sure.
It's interesting here, Bob, because the podcast business alone, Spotify setting aside $500 million to do all sorts of acquisitions this year, whether it's more podcasts or even some video content, as it looks to expand just beyond music. I mean, presumably they could tap more out of these brands, right? You get a podcast that's really successful on there. We've seen multiple times over a podcast then turn into a hit series. What kind of strength does that give Spotify potentially if it has access and ownership over that content?
Well, that's again what I'm looking for, and that's what I feel is definitely the differentiator here. Spotify's ahead of everyone else in getting involved in this podcast space, which I don't believe is going away. It's going to do nothing but grow. I feel that way about online content, such as Cheddar, for example, and I feel that way about podcasts. That is the way people going forward are listening and getting their content. I have 3 nieces. I have never seen them turn on the TV one time in their entire short lives. I think that's the way these things are going. That's why I think somebody like Spotify may get taken out, but it's still, that would help the investors medium term if they decide to get into this stock.
Biggest rival to Spotify right now, who should they be most worried about?
I think Apple. I just think Apple has the bandwidth, they have the infrastructure, they have the universe that'll get people to just adopt that. Verizon now offering Apple Music for free if you switch over to their network. They've got the relationships and they've got the money to make a serious challenge. They could potentially be the one that takes them out down the road. I'm not predicting that in the short term. I don't want somebody to buy the stock based on that, but that's the way that I would look at that developing.
Let's talk about Alphabet here, Bob. Alphabet going to report after the close today. It's looking at a nearly $2 billion fine in the first quarter that it had to pay out to the EU over its advertising practices in Europe. What are you expecting from the report this afternoon?
Well, 2 things on Google. I expect them to beat, and then I expect them to fall. And the stock price, I mean. And the reason I say that is you mentioned that fine, and that's a known. What we don't know is how much of Lyft's, the profit they made on the Lyft IPO is going to report, how far they are with autonomous driving, which I think is just a major growth area for people like Uber and potentially Google as well. And I think you have to look at how much that fine offsets with what they've done. Advertising revenue has not slowed down. We saw that with Facebook. The privacy concerns have not hit Google publicly as much as they did Facebook. The thing I don't like is I don't like that the stock has run up 22% in 2019. That's a big run up, anticipating all but perfect earnings and revenue and growth. And that's usually never the case. Alphabet would be something that I'd look at buying if I got a significant dip after earnings, which sometimes happens when you get these run ups.
I'm curious about other parts of the business, specifically the rivalry that now is increasing between Alphabet, specifically Google, and Amazon, not just in advertising as Amazon becomes a more formidable force there, but also in terms of the cloud. What are you looking for in terms of those spaces?
Well, I think you're going to see, I mean, obviously Google has not been a leader in the cloud as of late, so you're going to see a jump in there that I think is going to interest investors. Taking market share from away from Amazon, I think, is going to be difficult. The space is growing, and the potential for Google to take a larger chunk of that added space. Everything is going to the cloud, so Google's going to have some advantages getting into it. But I think Amazon's cloud business, we saw it suffer a little bit, but it is a behemoth. I don't think they're going to be able to take too much market share in the short term from Amazon.
Bob, one of the less talked about topics in this earnings report, even last year too, was the $4 billion just in investments Google made back in 2018. And, if it could be a winner this time around, obviously was an early investor, and Lyft has had at one point about 13 million shares. When you look at the investments, how are you expecting that to impact Google here in the latest quarter?
Well, that's one of the places I think could drive the stock up over the medium term, which is why I say that if they hadn't run up 22%, I'd probably be long the stock, at least in options, going into earnings. But that's part of the reason you mentioned the investment. That's one of the main reasons why I want to kind of get in a buy and hold situation with Google. I just need a better price than it's at now. And again, that's part of the 22% run up. We tend to like a stock fundamentally, and then we use price action, and to a certain degree, I hesitate to call them technicals because it's really an auction, it's price action. But using price action to get in at a better situation. If you could see a 3-4% move for Google, I'd start to accumulate the stock, looking at holding it about 18 months at least.
All right, Bob Iaccino, Chief Market Strategist at Path Trading Partners. We got a busy week on deck. Thanks for joining us.
We do. Good to be here.
Thanks, Bob.